Hey everyone, welcome back to another episode of Consulting Corner. I'm Kelly Halfpap.
And I'm Buffy Johnson.
Today we're going to talk about premium payables, how they become out of balance, how you can fix it, and then how you can prevent it from happening again.
The main thing to remember when it comes to premium payables is that it is solely the relationship between the agency and the carrier or broker. Net funds are dispersed out of or receipted to the general ledger in Epic, depending on the transaction. When an agency bill transaction is entered on the client side, it creates a payable balance under the carrier or broker's GL code to be reconciled in the general ledger. Once the premium payable is reconciled, depending on the transaction, funds are then either reflected as a disbursement out as a payment to the carrier or receipted as a return premium or commission and applied to that premium payable entity. You will want to run this report to see if your general ledger premium payable balance ties to your premium payable detail. The report to run is called Month End Balancing Current Premium Payables. Make sure you run the version of the report that we received in the Applied Epic report pack, and it's the one that has the asterisks. So after you run the report for the accounting month that you're wanting to verify, you will go down to the bottom, and at the bottom of this report is the summary of all of your premium payable entities. And if it's highlighted in yellow, that means that your general ledger balance is not in balance with your premium payable detail.
So, how do premium payables become out of balance? There could be many reasons this could happen, and the most common that we typically see are number one, premium payable has been created in the general ledger. You paid the carrier online, but did not record the GL disbursement against the premium payable reconciliation. Alternatively, you paid the carrier and reflected the disbursement to the payable GL code, but the premium payable reconciliation was never created and associated to that disbursement. Number two could be return premium funds are not applied against the negative premium payable reconciliation. We've seen funds applied directly to clients' accounts or maybe against the agency's commission GL account. We've also seen where the funds are associated to the carrier's GL code, which is correct, but the premium payable reconciliation piece again was just not done. Number three could be transaction agency commission amount is incorrect. We've seen agencies bill off of the quote before the invoice is received, but oftentimes premium taxes and fees will change slightly at binding. So the invoice itself will always be the most accurate. If agency commission is blank on the policy application or not updated at renewal, your premium payable reconciliation total will be off. And then finally, number four, a manual journal entry was done that could have been entered incorrectly to the company or broker's GL code. Examples of this would be a duplicate PPE. Maybe the balance is under one PPE, but the disbursement and receipt is coded to the duplicate. This could also be the disbursement itself was done out of the title account payable and not to the carrier's sub-account payable. And then finally, it was just that journal entry just should have never been entered in the first place is incorrect. So we've talked about how premium payables become out of balance, how to fix them once they do. Now let's talk about how to prevent it. The first would be make sure you're completing the premium payable workflow. When a policy is bound, it should be transacted to bill the client out of Epic. While the invoice will be the most accurate, if you do not receive it right away and need to bill off the quote, be sure to go back to those transactions once you do receive the invoice. If you find that premium, taxes, or fees may have changed, revise the incorrect transactions. You may have to bill the client for additional premium or refund if they overpaid. When funds are received and applied against the transaction's AR balance, the next step would be to create the premium payable reconciliation. When you're ready to pay the carrier, take that reconciliation and do actions pay statement. This creates the disbursement, which is directly tied to that payable. If you are receiving return premium funds, make sure the cancellation or return endorsement is billed in Epic, reconciled as a separate premium payable entry, which is then tied to that receipt. When you are transacting an agency bill invoice, make sure the taxes and fees are split out from the commissionable premium and that your agency commission amount is correct. When you're creating the premium payable entry, either from an agency statement or an individual invoice, make sure those accounts and balances match to that statement. If you find errors while reconciling the premium payable, go back to those transactions on the client's account and fix before continuing. And then finally, there really should never be a need for a manual journal entry against a premium payable GL account. Exceptions for this would be reclassing from one PPE to another or for cleanup. If you have any questions about premium payables or other applied Epic accounting processes, do not hesitate to reach out to us at consult@kitetechgroup.com. Thank you for joining us, and we'll see you for the next Consulting Corner.